Alright everybody, welcome along to this pre-market analysis video. This is as we transition into Wednesday's session worth of trade. That will be Wednesday the 3rd of June 2020. It's been a week or so really since I left you with the last public address. Again, we continue to watch these markets more closely in that weekend analysis class each and every Saturday. But it is time, right, for me to come back and to actually recap the US financial market indices as they continue their epic melt up. Again, even continuing into yesterday's session as at Tuesday. The S&P 500 for the first time really, it has moved above this red rectangular box on my screen. We've had this here for a number of months. This is going back to April. Again, we've been paying attention to the 100 and the 200-day simple moving averages. You can see actually that they are still, right, bearishly aligned. However, this is now the fifth session as at the close on Tuesday, whereby the S&P 500 has held above its 200-day simple moving average. The monthly charts, very important, the 10 and the 20, exponentially weighted monthly charts, again, based off, right, where price action is trading at the moment at 3,080 points. We are holding above them. However, it is not the case for all of the markets. These markets are still largely bifurcated, right? All you need to do is look at the discrepancy between, say, the Russell 2000 and that of the NASDAQ, which I'll transition over into in a couple of moments' time, just to understand that there is still, right, a lot of uncertainty. There is a lot of volatility in these markets. And really the premise, or at least the general sort of thesis and consensus view out there by and from market bulls, is that the Fed, again, has their back, all right? As bad as what the economic news has been, as bad as what some of the civil unrest in the United States at this particular juncture is, people are seeing, of course, bad news as good news essentially as, right, they see it as an appropriate measure for the Fed to continue their quantitative easing. That whole premise or that thesis, or at least the backstop as to why people continue to buy the dip and to jump back on into equity prices at this particular time, is really a little bit perplexing to me, right? I understand the viewpoint, the narrative of that. But again, historically speaking, when you follow along with some of the metrics that we do, and if we look back historically as to what has happened on every single occasion when these metrics are giving the signals that they are at this very same time, right? Equity prices rarely, if ever, hold up. And it's interesting to see, if I can flick on over, again, this has been the first video recap publicly for about a week or so, whereby we're looking at the NASDAQ now, and we're within a stone's throw, right, of the recent all-time highs going back to February of 2020. I mean, this is really only 3 months ago at this particular time. Here we are. We're moving into the third trading session in the month of June. We started the meltdown about mid-February, and here we are trading at 9,608 points. The all-time high on the NASDAQ was just shy of 9,800 points. So again, we're within, say, 200, so to speak, on the NASDAQ of actually creating a new all-time high. And in this day and age in particular, right, people have relatively short attention spans, right? Not here to upset anyone when I say that whatsoever, but a lot has changed, of course, since the mid-February peak. This market, you could say, or markets collectively, they were priced to perfection, so to speak, pre-COVID. And here we are again, 3 months later, still in a global pandemic. A lot of economies, or at least provinces, states, so to speak, reopening their economies. Unemployment picture has certainly changed at this particular point in the last 2.5 months. 40 million people have filed initial unemployment claims. We revised down Q1 GDP to what, almost negative 6%. We're looking at a revised quarterly GDP for the second quarter anywhere between 30 to say 45% on the decline, obviously not annualized. And we still have this narrative going around at this particular point of a V-shaped recovery, right? I would be very surprised at this particular point, as I have said off from these compression lows on the S&P 500 dating back to March 23rd, right? I would be very surprised, I'd be shocked if the S&P 500 can get above its February peak, right? This narrative that I've described in the past, going back to very early on in the period of 2020, it's gone. And there's a lot of retail investors. I mean, I don't think you can really call them investors at this particular point, but very aggressive, very speculative, right? Punters, in other words, that are jumping into all sorts of risk that I do not fully think that they really understand. And in circumstances like this, right, in my opinion, it pays to be patient. All right, a lot of people jumping into, right, the stocks that have been hammered the most in that 1.5 month period from February through to pretty much the end of March, thinking that they're buying a lot of these stocks at a discount. If you look at fundamentals or valuations of where we currently are, a great chart of this, by the way, is the Wilshire 5,000. I'll bring this up. This is the total, right, market. We're not going to look at the 4,000, but I'll bring up the 5,000 total market index. But this market in particular, this is what they call, of course, the Buffett indicator. We're now printing, right, or at least the entire market cap of the Wilshire 5,000 is now approaching 150%. We are within literally a couple of percent off from the 2000 peak, right, whereby outside of 1929, valuations have been in recorded financial history the most stretched ever. And here we are, again, in the face of uncertainty, a global pandemic. Unfortunately, it's an absolute tragedy to see this on the news. I don't live in the United States. I don't reside in the United States. I'm from Australia, but I do watch, of course, trends in the States very closely. But to see the civil unrest over the weekend exacerbate probably a lot of problems that small business already have, outside, of course, and I say this, and it goes without saying, really, the tragedy that happened in Minneapolis really as the tinder to sort of start all of these peaceful protests that unfortunately some have obviously turned into disobedience and all-out riots in some areas of the country. But think about the small business standpoint that's already stretched from the likes of Amazon, the complete retail apocalypse at this particular point. And then, of course, to think about the damage which is now inflicted upon these small businesses around the country and the uncertainty, the consumer uncertainty, right? 40 million people who've lodged, their initial unemployment claims already in the past 2.5 months. GDP that's falling off a cliff. You've got the entire bond market, the structure of that isn't paying attention whatsoever to this equity rally. In fact, a lot of the yields on some of the very important, or all of, right, the important treasury bonds are still below where they were. Dated back on March 23rd, and to see this complete disconnect in equity prices, I can only assume, right, that at some point, and this is really, if you look at the institutional flows or lack of, right, into the US financial markets at this particular point, a lot of these gains, right, the smart money, or what is referred to as smart money, is simply stayed on the sidelines, whereby the retail holders or the retail speculators, I believe, are going to be caught holding the bag. I mean, in fact, if you look at the statistics on Robinhood accounts that are being opened, the number of positions, let alone the positions, say, for instance, in Hertz, that's pretty much formally declared bankruptcy at this particular point. It blows my mind, and very, very rarely, if ever, in history, do we see these types of market events whereby you see a market itself or a collection of markets sell off beyond 30%. I'm not talking about a run-of-the-mill 20% correction, but to push beyond that by a further, say, 15% on the S&P 500, whereby it was sitting down 35%, and of course, the big forward-looking macro indicators that we follow, and the unemployment figures too, just to mention a couple. To see this, and then to see this compression rally move as far as what it has in such a short time frame, it's really quite incredible. Right? I'm not annoyed, I'm not frustrated, I'm not ticked off whatsoever, but this has gone even higher than what I first imagined, or what I've been imagining, right, since and off from the March 23rd lows. Right? I don't want to see, of course, the equity markets move beyond or below these areas. I just assume they will. And the reason I say that is because the majority think it's impossible. When you think about the euphoria, right, or the sentiment indexes that are screaming euphoria beyond a state that was up here in the period of January and February, here in the period of June, whereby if you look at the market caps, or at least where they are priced, outside of the NASDAQ being still in context below the all-time highs, across the board outside, or really including the NASDAQ even at this particular point, but I assume we are going to see the NASDAQ create somehow a new all-time high, which is just going to sort of lead off some pretty mammoth macro divergence again, or at least the continuation of the macro divergence, which has been establishing since 2017, whereby again, global growth essentially stalled out in late 2017, early 2018, or global GDP at least. And now you see some markets anyway in Europe that are celebrating initial unemployment claims, right, that is still surging beyond anything recorded in their own financial history. But they're assuming that this is going to be the end or the worst of the unemployment scenario, whereby we sort of reached, or it's already sort of hit its max based on where we currently are. Germany, for instance, came out less than, I think, 3 hours ago. Believe, pardon me, they're expecting a further 190,000, right? Equivalent initial unemployment claims. That figure came in at 238,000. However, it was far below, obviously, the peak more recently in the month of April for them, which I think sort of peaked out at 350. So technically, the unemployment claims are dropping. But again, relative to where they have been leading up to the market peak, they are beyond anything that large parts of the Eurozone have seen, right? Even factoring in, of course, the market transition back in 07, 08, 09, leading into that big macro transition. And I assume a lot of this sort of euphoria that we're seeing in the States as well is anticipating a drop in, or at least the continued drop. I think at the moment we're just above, 2.1 on average now in a weekly print. It's dropped considerably from that initial print of, or at least the print high of 6.6 to 6.8 million, somewhere in that vicinity, whereby you get the spike and it's slowly coming back down. But a lot of people are assuming that the worst is already beyond. Structurally speaking, it's simply not the case, right? Structurally speaking, this is going to take a number of years to recover from. So this V-based recovery that we're seeing in price, it's getting very, very ahead of itself. And if you think about all recessions, really, structural recessions, can you remember a time whereby a structural recession, to the extent that we have at the moment with, again, 40 million people, I believe it now is 1 in 4 people who were employed in the month of January 2020 are now officially unemployed. And another crazy statistic, right, is that if you look at it by race as well, I know that's a very polarizing subject, and it has been for quite some time, and it is certainly heightened at this particular point. But if you consider, right, the more recent record unemployment rates in the African American communities, now that figure has flipped, and it's flipped considerably, to the extent that there are more African Americans at this particular point unemployed than actually employed. Just think about that for a moment. You've got a total workforce in the month of January whereby 1 in 4 are now formally unemployed on government assistance. And then if you want to sort of micromanage this or look at the minutiae of it, again, don't want to repeat myself, but just said it moments ago, you can go back and push play, but that is factual at this particular point. And to think that this market, that again, GDP barely growing, just above 2%, to see the extent at which these markets have been, or at least not the market, but the economy itself has been hit, to see that sort of that sentiment shift whereby people who thought this was a safe thing, a safe bet, the market is only going up, to see them absolutely terrified and petrified. Again, this is only going back to the month of March, how quickly sentiment shifts. People thinking that this is the least risky market in their lifetime to being the most scary market in their lifetime, to come back and to see that sentiment shift where it is now, to see such euphoric readings in sentiment. Very rarely, if ever, do you see a market low put in, right? Or at least a rally off from market lows turn to euphoria as quickly as what we have seen, right, in the past 2 months since March 23rd. This is all happening as the Wilshire, right, 5,000 total market cap index is coming back to retest a pretty critical level, right, just above 31,000 over here. Very, very rarely, pardon me, do I talk about the Wilshire. But again, it's the Buffett indicator. It's here for a reason. And again, this is pushing or approaching 150%, right? The market cap to GDP. So all of the goods and services would equate to 100%. This is still another 50% on top of that. So again, the 2000.com bubble, it peaked out only a couple of percentage points above where I believe we're currently sort of priced at. Obviously, it's not updated daily, or at least I don't look at it daily, but we're within a literal stone's throw away. We're coming back and up to retest a very prominent, important trend line. And again, when you look at this historically speaking, generally that 100 and 200, after such a mammoth sell-off and a very clear recession that we're already in at this particular point, don't wait until August for people to tell you that you are formally, or we are formally in a recession. It's too late, or it probably will be too late at that particular point. But we're already formally in a recession to the extent and the magnitude that something we haven't seen, especially far beyond 2007. And to assume that price is already recovering and re-entering a new bull market after such, or statistically speaking, the longest bull market or macro expansion in the history of finance, to assume that it's done, that it's run its course, I personally find that very hard to believe. Right? I find it very, very hard to believe. I'm not a cynic, right? I'm not a pessimistic person. All I'm trying to suggest right now, and really what I'm trying to do for you, is just to sort of look out for you and to give you the facts, not only technically speaking, but also from time to time, fundamentally speaking as well. Predominantly, technically speaking. And just because we see price action on the S&P 500, which is really the centerpiece of my analysis anyway, I think it's a good middle point between that of the NASDAQ and Apple. Just because it's held above its 200-day, for 5 sessions now, it really doesn't change the landscape at all. I mean, again, historically, volume is trickling out of these markets. There's been really a lack of institutional buying in this market during this rebound, especially over the past 1.5 months, you could say. There's a lot of retail investors occupied with the stock market, as obviously sports betting is all closed down, and they're sort of throwing Hail Marys into companies with really no clue what they're doing, right? Fundamentally or technically speaking whatsoever. And you can only assume that they are going to be ultimately the bag holders, right, holding these companies when this flips around. Now, again, a lot of people are just willing to buy this market, buy indiscriminately when it comes to individual stocks, based on the premise that the Fed has their back. And again, personally, I think that's very dangerous. I know it's quite powerful to believe in, but I don't think the Fed itself, right, can sort of bootstrap this economy, let alone the markets, up for all that much longer. Okay, there's a very big disconnect what's going on in the market, right? What we're seeing at this particular point, the outperformance of the NASDAQ relative to, right, the other markets, outperformance that we haven't seen during, of course, the bear market rally in 2001. And the bear market rally at that particular point going all the way back to 2008. Okay, and we're seeing it exactly right now with valuations as stretched as what they are, with a very uncertain outlook about the global economy, let alone the US economy, and even if you wanted to think about it, the political change that may happen later in this particular year. Right, this is not politically motivated whatsoever, but it is an election year. The election is happening, I believe, November 3rd. And obviously it's hard to believe, but there is going to be optimism, right, coming into that election. Who knows what the result is going to be? But it is an election year. And generally you see these transitions, if you go back and have a look, they generally coordinate on the second term of a presidency, or at least the transition in an election year of a presidency too. So, all of this is aligned quite nicely. You think about this bullish rally so far off from the March 23rd lows. A lot of people just, again, purely speculating at this particular point, right? On a number of different shares. There's a lot of short squeeze sort of plays happening at this particular point. But I think above all else right now, consumer behavior to some extent is going to change. It's going to shift long term because I believe people have really been frightened by COVID, right? A lack of security, spending frivolously really out there in the economy. There's some great companies that really highlight this. And I think consumer behavior to a large extent is going to change. All right. And if people begin to not spend as frivolously as what they were, if they tend to save a little bit more, actually save for a rainy day after such a shock that has occurred more recently with COVID, that's going to slow things down dramatically. Let alone, of course, the economic future indicators that are as terrible as what you could imagine, right? There's obviously going to be a rebound. We're going to see the rebound in Q3. But to think that we're going to approach anything remotely close to a 2%, right, GDP print in Q3 or even Q4 or even in 2021, I really encourage you to reconsider. Here we are, we're in a contraction already. We're in a recession already. And people are being led by a V narrative. That's literally it. And the Fed has your back. I mean, to me, that sounds like something for nothing, and very rarely, if ever, is anything something for nothing. It's almost as if this market, right, there's no risk in the market. People are just blindly speculating all over the place. And I think there's going to be some really terrible, right, consequences for what's happening, or for people anyway, who are joining this phase or this craze, this FOMO effect, and assuming blindly, with very little thought, that the economy is going to mimic anything closely to what it was pre-COVID. All right. Now, if I can just quickly, I showed you the Wilshire 5000, the total market index. Let me just show you the Russell, because the Russell, if I can put a dollar sign in front of the R and bring this up, I showed you that back test, which may be underway on the Wilshire. If I show you the Russell, and I'll take this off my screen, I'll try and remove the annotations. These are what we call decelerating fan lines in the world of technical analysis. And again, when we extend the fall, generally they happen in groups of 3, by the way. Sometimes they can operate in groups of 4. But the Russell has really been probably hit the hardest, right, of the US indices. It's been on a big rebound, right? But it's rebounding once again back into, right, roughly this 1450, just shy of 1500 area. So it's something we've pinpointed and spoken about at length, ad nauseum, for quite a long time. Pay attention to this. It's very important. Right, this is outside of the S&P 500. NASDAQ, a little bit different at this particular time. Again, still building divergences. But pay attention to this in combination with the Wilshire 5000. Could be absolutely critical. Again, if I extend this into something more closer to home, I can show you this on the Dow Jones Industrial Average, which again is still taking off. It's rocketing back and up to move back into, hypothetically, that right shoulder, which again is working in sort of synchronization with the global growth slowdown that began in late 2017, early 2018, outside, of course, the 2019 year, where I assume we have created now some form of a head to be some larger, right, head and shoulders chart topping pattern. But again, you're getting this reflux rally off from the lows, coming back on up, as we've said and spoken about, to roughly 26,000, right? Some of these markets, obviously, as I alluded to, the NASDAQ outperforming. And when I say outperform, I'm talking about just how quickly they're clawing back a lot of these original losses made during the COVID lockdowns. But these discrepancies that you're seeing, whereby you've got the NASDAQ pretty much equivalent being up here, right, back at the all-time high, and to see where the Dow Jones Industrial Average is, to see where the Russell 2000 is, to see where the S&P 500 is, to see where the Wilshire 5000 is. Often, and historically speaking, it happens in the first bear market rally, and that's where I still assume we are at this particular time. But anyway, the Dow Jones is still clawing its way back on up. It's getting closer to 26,250. If I bring this up on my screen right now, you can see we're piercing, above the 100. Coming back towards that 200-day simple moving average. I've shown you that same illustration or overlay on the S&P 500. Again, 5 sessions now. I think that's the 3rd time I've said in this particular video. We've got the NASDAQ well above it at this particular point. But again, when you look back and just acknowledge, right, all of these open windows all over the place, I mean, that is not a sign of strength, right? Or at least not longevity. World of analysis suggests that open windows will be filled, especially when it comes to indices too. And to see the amount of action we're getting in the futures markets when the markets are technically closed and we're seeing a lot of illiquid trading in the futures markets, to see the amount of gaps up in the markets, which are just, again, which is the reason largely why we've got so many open windows, it's not a sign of a legitimate, healthy market. So you can see that in the NASDAQ there. Again, it's going to be interesting to see whether or not we can actually create a new all-time high. I'd be fascinated and amazed. Maybe it's coming. But when you look at these other markets, they are still considerably, right, well below where they have been. And again, a lot has changed between February 15th or February 17th and obviously where we're trading at very early on in the period of June. I think people who are patient and are not willing to run on out and to buy a handful of a selection of companies, or really any, right, long-term investments with the valuations that we're looking at this particular point, let alone the broken charts too. I think that those who are avoiding the almost compulsion to do such a thing because they assume everyone else is doing this and everyone needs to get in before everyone else, before this, rockets off and creates again another trend breakout, bullish continuation, all of these types of sort of nonsense that we're hearing, right? I think those that are patient are going to be rewarded, number one, because they won't be holding, right, a bag of stocks that do make the U-turn at their critical resistance areas. And two, I think you're going to have a lot more opportunity in the future to buy shares at a much, much lower price as to where we are now, and also a much lower price as to where we were back in the period of March 23rd. I know, right, no one believes that, right? No one believes that's even possible, right? But generally in these instances, if that is the consensus view, and again, you have to think about it, what a bear market rally is designed to do. In essence, right, it's meant to sucker in as many people as it possibly can during the return to normal phase. The return to normal phase is where we are in the sentiment cycle of this entire move. So I'm not changing my standpoint on the markets. I'm not in pain in doing so. Yes, I have short positions open in the market, right? Gone through and done risk and money management before applying, obviously, these positions. And also on that note, the positions largely that I'm holding don't expire all the way through to May of 2021, far beyond, right, what we've experienced over the past 2.5 months. Strategically entered into them, by the way, not like down here, obviously. You can see my whole entire catalog of this and profiling the markets for an extended period of time. I'm happy to watch this and to let it do its thing. See it beyond, of course, the November presidential elections, and to see how long people believe that the Fed can somehow elevate equity prices and somehow hold or appear to hold the disconnect between Main Street and Wall Street at this particular time. There's a lot of talk now about negative interest rates, or at least the futures markets are again continuously, at this particular time, again moving toward negative rates, early 21, late 20. If you look back historically at what that's meant for markets in Japan, especially the banking index and the banking index of Europe soon after they went negative, right? Not to mention the broader equity markets. Everyone's talking about negative interest rates as a panacea to somehow support the V market recovery narrative. But again, if you look at the consequences of policies, especially monetary policy, and taking rates negative, if you are a bear, right, in the market, and I don't think anyone is long-term or is 100% bearish, but I think people recognize the risk in this market, what's happening in the world, where valuations are at, and obviously we're at the very front end or the front curve of a recession that we are firmly in at this particular point. And again, people with, I guess, a spark of objectivity and can remove themselves emotionally from this market really understand that if rates were to go negative, it's not that golden panacea that some of the Fed governors are talking about at this particular point. Right? If you were bearish on this market, you would be you'd be championing for negative rates. I don't think they will take rates negative. I don't think they can take rates negative. And we're at zero. We're zero bound for a very long time. Right, we're at zero for a very long time. Interest rates are certainly not going higher, and there's serious consequences for taking them negative. I think we're just stuck essentially in stagflation for the time being. And equity prices, if not very close to, right, are at or very close to a ceiling that if we see a turn, they probably won't revisit again for a very long time into the future. That's more of a macro outlook. You can bring it back into the technicals and you can say, well, we're above the 100 and 200. That's bullish. Well, I think you're missing a little bit of the context here of really what we're talking about. Don't pay attention to the exponentials. Okay, during a sideways market move, which is clearly what we are in at this particular point. You've got the resistance up here. You've got the support down here at March 23rd. We're stuck. Well, we're not stuck right bang in the middle anymore. We're sort of moving up towards, say, I think at this particular point, probably a 68 to 71% retracement. 71's another fib ratio. I don't pay attention to it. Not really all that helpful. But we're still within the range. So again, you don't pay attention to the exponential moving averages. A lot of people are going to assume that they're support. They are not. The reason is because we are oscillating. So pay attention to the oscillators. Look how overbought we are. The euphoria is real. RSI is up here at 73. We've got the MACD off the chain. Stochastics is up here at 90. Again, just hanging out at 90. If you go to the monthly charts, however, it really looks, if you look at the divergence across the board, the number of years, I know there's annotations all over my screen. I'll remove them very quickly. But if you look at this just here, you see the divergences forming and building for a number of years. You've got this 2.5 month, not even, 2-month relief rally, which has completely changed the sentiment. It's just got bear market rally just screaming out. Okay, you've still got that 50-day, by the way, position below, right? The 200-day simple moving average. So if you go back and look at this, although price is above the 200-day simple moving average, if I can just very quickly take you back and show you this. And I know I haven't recapped the monthly charts, but I'll do that in another video too. But if you go back and look at past macro changes as well, you get these periods whereby the 50-day crosses below the 200, and then price will get very close, if not overshoot the 200, and the 50 will get very close to the 200. However, the 50 won't break above that 200-day simple moving average up until the point whereby we enter into a new bull market, right? Very early on in the period of 2009. Pay attention to that because, I'll go back and I'll show you this again in the year 2000 as well. Another good example of this, whereby you see the 50 is just holding above the 200. It gets below it, you get the cross. And although we didn't get back on up into the 200, the 50 never moved back above the 200. So again, here's a good example of it. See price action, it gets above the 200 day. However, the 50 remains below it. It gets very close in this period over here. This is going to April 02. This was not the bottom. So people probably were assuming that this was the bottom over here. 1075. Again, it took another 4 months for the bottom to break. And then it continued until the flush out low, whereby the 50 again was well below the 200 up until the point we get that definitive cross. Okay, to May 3rd. So a lot of people are thinking very quickly, rightly so, technology, obviously. We live in a very connected world relative to where we were even in 2007, right? Completely different world if you go back to 2000. But a lot of this is similar. It just rhymes and there's some little sort of differences, right? Even though the pattern or the picture itself is very similar. So until we see the S&P 500, the Dow, the NASDAQ, all break out to all-time highs, or until the Russell 2000 again confirms this move, or until the Dow Jones, right? Dow Jones Transportational Average confirms the industrial average. And again, this is just another market that's coming back to retest some of these critical areas. If I can show you this, the 100 and the 200, and the back test of this very important trend line as well. It's until we see synchronicity and confirmation between these markets, I think it's very important for you to understand where we are, to understand we're at the very front edge of a recession. We're already in one right now. And I think this V market narrative recovery story, I don't even know where it came from, where it's being perpetuated from, is an attempt to elevate, of course, sentiment in the market. It's already at euphoric readings. Prices are right in the vicinity of resistance. They're still in context well below on whole, right, where they were in February. And this is exactly what markets do during this first rebound attempt. So anyway, I don't know how long I've been talking for. I've just been talking into my microphone here. I hope you appreciate it anyway. Again, this is as we transition into Wednesday's session. I hope that you remain safe and you're out of harm's way. For my friends living in the United States and also around the world and the broader sort of COVID environment as well. But for those in the metropolitan cities in America, it's probably best to sort of keep your head down, stay out of harm's way. And it's, again, just a real tragedy to watch it unfold, all right, or on the television as well, even from down here in Australia. So I wish you all the best. I wish you, I hope you stay strong. And I hope you take something away from this video as well. If you have questions, email me, success@pivotpoint-trading.com. Otherwise, everyone, I'd say keep a cool head. I think patience is a virtue, and I really believe that people with it are going to be, at least they'll be out of harm's way as well in terms of the markets. Okay? I'm going to say farewell, and I'll be back with you. I'll be back with you this week. Okay? I'll be back with you this week. All the best, everyone. It's James signing off on behalf of Pivot Point Trading. Farewell.